Good evening, everyone. I hope you can hear me. I am Soni Dua Karan, and we are going to take some sessions for your understanding of fundamentals of accounting. Basically, not of accounting, I would say things related to your investments in stock market. So, what do you need to analyze as an investor in a company before you go ahead and buy the shares of those companies? Also, I would like to know whether all of you are comfortable in English or you want me to repeat the same thing in Hindi as well. I am okay with both the languages. I'll just see if somebody has told me to speak comfortable with both. English is fine. Perfect. I'll still wait for others to join and then we start with our fundamental learning. Even if we are not from the finance background, we are here so that you are able to understand the basics of some terms so that you can go ahead and take your own decisions while you are investing in shares of the companies. So the first thing that we need to know while we are studying the balance sheet or we are seeing the financial statement of a company. Now, when I use the term financial statement of a company, what does that mean? It means the statement which is telling me about the profits, the losses of a company. Now, I think these two terms are very clear for us. Profits means the money that we make out of our investment or by selling our products, and losses would be Sambit ji, as for your question, yes, fundamental analysis is more about investing for a long term, but it is also required if you are thinking of short term investments. Then also it is good. Yes, my screen is visible. If it is not, please let me know, everyone. Ravi ji, good evening. Even if you have just joined, you haven't missed anything. I was just talking about the first thing that I have asked everyone is if English is comfortable for everyone, then I will not repeat the same thing in Hindi. If my screen is not being shared now, could you kindly check? Okay, now if it's visible, great. I was talking about the first thing that before investing in a company, even if we are not from the financial background, we see is the financial statement of a company. When I talk about financial statements, the financial statement tells you about the profits and the losses that a company makes. Now, I am pretty sure that we understand what do I mean by profits. Profits are money that we make out of our business activity by selling our goods or by selling our services. And of course, losses would be the money that I lose by doing my business activity. And as a company, nobody wants to lose on their money. The second thing that the financial statement shows us is the assets and liabilities of a company. Now, assets are something that a company possesses and can sell in the market for cash. So anything which will fetch cash for the company, when once that product is sold, that asset is sold, that would be termed as assets. And liabilities are opposite of assets. So assets give you money, whereas for liabilities, the company has to pay money. So we say the basic definition of liability is the amount that I owe, OWE. So when I say I owe, that means a company owes. Is the basic definition of asset and liability fine? I hope you can gather my language. So I will go again. Liability is something which I owe. As a company, I have to pay to someone. That's a liability. Asset is something which I own and I can sell in the market for cash. Now, assets are also of two types. Liabilities are also of two types. Two types of assets are non-current asset, and the second type, of course, would be current asset. Liabilities are non-current liabilities and current liabilities. Now, the basic definition or the basic understanding of these liabilities or assets are, if I talk about non-current assets, in other words, they are also known as fixed assets. Now, what are these? Those assets which remain with us for a period of more than one accounting year. So if I take the example of our houses, air conditioners, your furniture, sofa, bed, almirah, these are things which we don't buy every year. These would be known as non-current assets of our home. Whereas current assets, things which we sell or which we change every year, that would be known as current assets. So from the point of view of a company, non-current assets are those assets or those things that we own for more than one accounting year. That is more than 12 months. So I'm going to sell them off for after 12 months. That would be termed as non-current asset. And of course, it is going to give me cash in times to come. Whereas current assets are those assets which I don't want to hold on to, which I will sell within one accounting year. And then it gives me cash. So supposing my business is to make pens. Tell me one thing, if you are the producer, you are the manufacturer, you are the owner of a company which manufactures pens. Now, you know your pens will be sold in the market, it will give you cash. So that tells me it's an asset, right? But as a producer, would you like to hold on to these pens that you have manufactured for more than one accounting year, or you would like to sell it off within one accounting year? If you could write your answer in the chat box, it will be a good thing for me because it will help me understand if you have understood the meaning of an asset and so on. Yes, Vikasji, you're right. Anybody else coming up with answers? Right, Rameshji. So the answers that I have got, everybody is telling me that yes, if it's a pen manufacturing company, I've manufactured a pen, my intention would be to sell it within one accounting year, to sell it as fast as possible so that I get cash. So that means that pen for the company becomes a current asset. Now, the same thing. The pen must have been manufactured by a machinery. Now, as a company, would you like to sell the machinery within one accounting year, or would you like to hold on to the machinery? That means you don't want to sell the machinery because that machinery is going to manufacture pens for you year after year. I'm again waiting for your answers. Correct, Anuji. It is machinery will become machinery whenever I sell, will give me cash. But I don't want to sell the machinery right now. Why? Because that machinery will fetch me money year after year by manufacturing pens. So that machinery becomes a non-current asset. Now, one more term that I used was accounting year. I think this we all know that the accounting year begins on 1st April. Say it must have begun this time on 1st April 2021 and will end on 31st March 2022. So that is the duration of your accounting year. Yes, Vanashri, it is machinery is a non-current asset. So I think now these two terms will be clear for you. Number one, what is an asset? Number two, what is a non-current asset? Number three, what is a current asset? If these three terms are fine, we move on to the liability side. Then in the liability side also, two types of liabilities are non-current liabilities and current liabilities. The definition remains the same. But here as a company, I owe the money. If I owe the money, I will have to pay the money. If I have to pay the money within one accounting year, it becomes a current liability. And after one accounting year, it becomes a non-current liability. Liabilities, if they are in the form of loans, are also known as debt. The first slide, which will be visible for you on the screen. So debt is a type of a liability. Now, again, the question arises whether it is non-current liability or it is current liability. Let's take an example. Yes, Anuji, interest on loan, we'll talk about this, but first let us talk about the example that I am giving you. Supposing as a company, I have taken a loan from a bank. The loan is for 5 years. So in the first year, the loan will have to be paid after 4 years, right? So it becomes a non-current liability. In the second year, still the loan has to be repaid after 3 years. It's a non-current liability. In the third year, it has to be paid after 2 years. Non-current liability. Fourth year, it is still after 1 year. later, non-current liability. But in the 5th year, it has to be paid right now in these current 12 months. So it becomes a current liability. Is this example okay for you? No, I'm not writing anything while explaining, but I have already made the PPT, and the PPT I think is visible for you, which we'll start right now. But here I was just talking about some more terms. Now, Anuji brought up a point. I told you I have taken a loan from the bank, right? If I've taken a loan, I'll definitely have to pay interest, right? Whenever I take a loan from the bank, do I pay interest every year? Anuji, it's vice versa. 1 to 4 years, it's a non-current liability, the loan. The 5th year, the year in which you have to repay the amount, it's a current liability. Yes, Vanashriji, interest on loan will have to be paid every year. So if I have to pay within these 12 months, it becomes a current liability. So two things we have spoken about. One is the loan. The loan initially can be a non-current liability, but in the year of repayment, it turns into a current liability. And the interest on the loan, that is a recurring payment that we have to do. It has to be paid every year, and therefore it is always a current liability. So till now we have done what is a liability. We have done it. There are two types of liabilities: non-current liability as well as current liability. Then we have done that all the loans that we take, they can be non-current in nature or they can be current in nature. Now you can very well distinguish what is current and what is non-current. One more thing that we have done is that all these loans that we take, they will always carry some amount of interest. And that one more thing that I want to tell you, the interest that it carries, it's a compulsory payment for the company. It does not depend on that the company will pay only if the company is making profits. No, come what may, the company has to pay interest on loan. And that goes for us also. If I've taken a car loan, I will have to pay interest on the car loan. If I falter in the payment, they take away the car. So why does a company take these loans? Of course, whenever the company wants to grow, it needs to improve on its infrastructure. It wants to improve on its technique of manufacturing. Whatever the circumstances, it is not always necessary that the owners will put in more capital. That is put in their personal money. So capital is money invested by the owners. It is not necessary that the owners will keep on doing it. So if they need the money, they will have to go and take a loan. So the loan can be for making growth in the company, for buying new machinery in the company, for buying infrastructure in the company, etc., etc., etc. So if we see and we read this slide together, it says debt is money borrowed by a company. I hope this line makes sense to you. It is clear for you. Debt is used by many companies for making large purchases. That purchase can be for land, it can be for machinery, it can be for any other company that they are purchasing, but it is usually when we need more amount of money. And we have done this, debt will always carry interest expense. So when I say interest expense, it means that amount of interest will have to be paid by the company, no matter the company is making profits or is running into losses. I hope the first slide is clear for you. If that is so, please give me a go ahead and we start with the second slide. Any doubts? I'm ready to take on those doubts immediately. Okay. Now, one way of classifying debt we have already done. What was that one way of classifying debt? Non-current debt and current debt. You also know the basis of classification. It is very simple. It is the time period. If within the 12 months, it becomes a current liability. If after the current 12 months, it becomes a non-current liability. Apart from this, debt can also be classified as secured debt, unsecured debt. That's right, Vanashriji. Debt means loan that a company has taken. And that loan can be of the one classification that we have done is it's a current liability. The second classification that we have done is it's a non-current liability. One other way of classifying debt is it is of four types: secured debt, unsecured debt, revolving debt, and mortgage debt. I am beginning with mortgage debt because that is more relevant today. Now, whenever we take a house, usually we take a home loan from a bank. If I want to sell this house that I have taken now, will I be able to sell it without the bank's permission? No. Why? Because I haven't returned the money as of now to the bank. If I haven't returned the money, that amount, that property is not only under my name, it is still with the bank. So anything mortgaged means its papers, its title of ownership is actually lying with the bank. And the bank has the actual permission to maybe sell it further. That is known as mortgage. So which in if we talk about in Hindi, it is known as girvi rakhna. So keeping it as a security with the bank, and I don't have the clear ownership to sell it. That is because I've taken a loan from the bank, and therefore the bank will not allow me to sell it till the time I repay the bank. Or nowadays, one more thing is happening: the bank transfers the same amount of loan to the purchaser. But that's a different story. Whatever the case may be, the bank has to give the permission to sell it. So mortgage is usually when I take a loan to buy real estate, that is to buy property. That is one type of debt that we can talk about. The second type of debt, secured debt. Usually, when we want a good amount of money, a larger amount of loan, the bank always asks for some security. Why so? In the sense that you run away with the money, you don't return the money to the bank, then it will be a great loss for the bank. And therefore, the bank keeps some asset of yours, maybe gold, maybe papers of your home or something that they keep with themselves, so that if you falter, the bank can recover its money by selling off those assets. This is where the banks have faltered and people have taken lakhs and crores of amount from the bank, and they have just eloped from our country. We know of the examples. I don't want to talk about those examples right now. The government is still fighting to bring those people back to our country so that they can be trialed and tested in our country. But let's see. So that is all because the banks did not offer them secured loan. Had there been secured loan, the bank could have sold those assets to recover the money. The third type of loan that we can talk about is unsecured loan. Now, what is unsecured loan? The one that banks had given to these people, they took money from them. They did not offer any of their assets as security, and therefore people could run away with that money. So when I don't offer any asset as a security to the bank, they have not taken any asset of ours as security. That's right, Anuji, I didn't want to take his name. When the banks don't offer anything, they have not taken of ours and kept it with themselves, but they've just given a loan, that would be termed as unsecured loan. And the last type of loan, revolving loan. Now, what's a revolving loan? Now, wherein a 10 lakh of loan has been sanctioned against the company's name, but the company does not want to utilize the entire 10 lakh. It has that amount sanctioned. Whatever amount it needs, it takes from that amount, and only that, say 1 lakh, 2 lakh, whatever it has taken, will be considered as its loan. The rest 8 lakhs is not the loan. Again, next year again it needs 1.5 lakhs. So today its loan becomes 3.5 lakhs. So the loan amount can keep on changing, and hence it's known as a revolving loan. So the four main categories of debt are secured debt, unsecured debt, revolving debt, and mortgage debt. The first type of debt, the definition written is assets with larger enough value to cover the amount of debt that is kept as collateral. Unsecured debt, wherein we do not give any asset as security. Revolving debt, amount that a borrower can continuously borrow from. Mortgage debt, debt used to purchase real estate. If this slide is clear as well, yes, of course, I can repeat revolving debt. Revolving debt is the debt wherein a particular amount of debt has been sanctioned, but the company does not utilize the entire amount at one go. The company keeps on taking amounts from that whole, say the loan that has been sanctioned for the company is 10 lakhs, but the company does not utilize 10 lakhs right away. It takes, say, it just needs 1.5 lakhs. So the loan considered right now for the company would be 1.5 lakh. Next year, again, it takes 1 lakh more. So next year, the total loan amount will be termed as 2.5 lakhs. So that type of loan, which keeps on increasing, or if the company returns the amount decreasing, that is known as a revolving loan. So in such type of loan, we don't have to take the entire loan at one go and return the entire loan at one go. Karanji, I hope it is clear. Yes, cash credit is for a short time. That's a current liability always, whereas revolving loan is not a current liability. It's a non-current liability. Yes, overdraft amount. That's absolutely right. Again, bank overdraft is a current liability, but a revolving loan is not a current liability. So just for your reference, I'm moving back to slide 1. Please make an effort to read it on your own, and then slide 2. If these two slides are clear, we'll move on to slide 3 in 2 minutes. Just give me a minute so that I can change it. Yeah. I want you to read it on your own. All right. I think you must have read it. The second slide, please. If this is clear, please give me a go ahead so that I can start with the third slide. Debt carries interest expense. That means if I have taken a loan, I will have to give interest on that loan. And as I said earlier also, that does not hold anything that if the only if the company is making profits will I have to give interest. Come what may, interest has to be given by the company, whether the company is making a profit, whether it is making a loss. So the the interest expense will increase the loss. But come what may, whatever the situation, the interest has to be given by the company. So it says debt carries interest expense. Vanishri ji, I hope it's clear. Now we come on to the third slide. If you have any doubts in the first and second, please ask. If not, then this is our third slide, which tells us how can we decide whether the company has enough loan or it does not have enough debt, or if it has more amount of loan, it's a good company. If it has less amount of loan, it's a good company. How can we decide on that? So we need to understand the pros and cons, the advantages and disadvantages of holding a loan. Now, as we have just spoken, that debt will always carry the amount of interest with it. And as I just said, whether the company is making profits, whether it is not making profits, it is making losses, come what may, I will have to give interest. So if I have large amount of debt, I will have to pay large amount of interest. And remember that interest will have to be paid. So my expense is there already. So it's more chances that I can go into losses because that amount of interest has to be paid. And that can put my company in danger. So it is not necessary that a good amount of debt is being shown by this company. It must be a good company. It carries its own disadvantages. And to counter the effect, if we read the second line, if I have no debt as a company, So I might be missing on many investment opportunities, many growth opportunities. Why? Because as the owners, I might not have the capital to invest every time. So although opportunities will be there, as a company, I don't want to take a loan. So I don't have the money. So I can't expand. That is also not good for a company. And second, most important thing that I want to talk about for a company that takes some debt, the interest that it pays on that debt is a tax deductible expense. When I say tax deductible expense, that means first interest is deducted, only then I find net profit. Once I found that profit, on that reduced amount, because I have deducted interest from it, that reduced amount, on that I have to pay tax. So my tax also gets reduced because tax is always charged on profits. So the amount of interest will reduce the amount of profits and therefore will reduce the amount of interest that, the amount of tax that I will have to pay on that profit. So that's what is referred to as interest is a tax deductible expense. So by showing interest, by giving interest, I reduce on my profits and consequently, I reduce on the taxes that I will have to pay and therefore I pay less taxes as a company. That's the meaning of it, that interest is a tax deductible expense. Ideally, that is the thing that that a company looks at, that the amount of interest paid is less than the amount of profits that I'm making. Otherwise, there's no need of expansion because I'm not going to make more profits. Then what is the need? Like, I will just put up a question to all of you. I know it is too premature, but let me try. Supposing I have an investment opportunity. In fact, you have an investment opportunity in a company. The company will have to take a loan at the rate 10%. So that tells me that supposing I take a loan of 1 lakh, I will have to give interest at 10,000. Now on that 1 lakh, the company is going to earn 8,000 rupees. So as an investor or as the owner of the company, would you go ahead with this investment? That is, take a loan of 1 lakh, give interest every year at 10,000, but I'm going to earn only 8,000 on that 1 lakh. Should I go ahead? Right. So this is what makes me know whether I will take a loan or not. So I analyze the amount of interest, I analyze the amount of money that I will make, and then only take a loan. I need to explain. Interest amount is deductible. As I just said, before I calculate my actual profits, I deduct the amount of interest that I have to pay on loans that I have taken from that profit, from the taxable profit. So first I deduct interest, I get the taxable income. On that taxable income, I calculate taxes. So what is it doing? The amount of interest is reducing my taxable income. If it is reducing my taxable income, it will reduce the amount of taxes that I have to pay. So what is interest doing for me? It is reducing my taxable income and therefore it is reducing the amount of taxes that I will have to pay in times to come. Vaishali ji, if it is clear, please let me know if you have understood the meaning of interest amount is deducted from taxable income. That is, it reduces the amount of taxable income. Why? Because I show interest as an expense. The expense will reduce your profits and therefore it reduces the amount of taxable income. Okay, there's one more question that I have to take up. It was, what are the sources of debt? The sources of debt can be any. I go to the bank, I can take a loan. I go to some other company, I can take a loan from them. I want loan from the public, I can take a loan from the public. So the sources of debt for a company can be any of these. The debt is used in a proper way by a company, that can be seen by return on investment. The example that I gave right now, wherein I said, if the interest amount paid on the debt is say 10%, but I'm going to earn only 8% from it. So as an investor, I would say, please don't. because every time I will have to bear 2% of the excess interest that I have to pay from my pockets, which is not correct. Vemula ji, I hope your questions have been catered to. Okay. Now, supposing the company has taken a very big amount of debt. In that case, the company will have to keep on paying interest whether the company is earning or not earning. So there are quite there are many chances that the company can become bankrupt also. Why? Because it is paying so much of interest, although it is not earning that much. So the company will have to pay out of its pockets, and if it has to pay out of its pockets, the company can become bankrupt. So then people say, okay, you have the assets, but no, to acquire so much of loan, the company will have to give those assets as mortgage also, no? So the company does not have any free assets to sell off, and it also has to pay interest, such a big amount of interest every year. So there are chances that the company will become bankrupt. Can you read this third slide, please? And if you have doubts in any of the language, any of the terminology, please go ahead, ask me to so that we can understand it together again. So a company with large amount of debt may not be able to pay interest, putting the company in danger. The company has chances of becoming bankrupt because it has to pay so much of interest. And the second thing, a company that uses no debt may be missing on expansion opportunities. The advantages or the pros of a debt can be more. There is more money in the company. Why? Because I've taken a loan. As I said, interest is a tax deductible expense, and therefore it reduces the profit and consequently reduces the taxes that I have to pay. With the amount of loan that the company has acquired, the company can use it judicially and expand its business. So that expansion will give more returns to the business, more profits to the business. But the disadvantages of a debt are, if there's a large amount of debt that I have taken, that amount of interest I will have to pay, and I'm not earning that much on my expansion. Therefore, I will have to pay out of my pockets, and the company can become bankrupt. And also, to acquire so much of loan, maybe I have given my property as mortgage, and therefore that is also not free, so that I can sell it and get the excess money required. So there are advantages as well as disadvantages of holding large amounts of loan. Okay, if this slide is clear, we move on to our fourth slide for the day, which is this. Equity, in other words, is what belongs to the owners of the company. So that's why I have said shareholders equity. So if it is shareholders equity, it means if I have the shares of a company, I am one of the owners of the company, and that is represented by the term equity. Okay, Vanishri, I'll definitely come back to your question. As we discussed, now supposing I have no loan, the profit that I have earned is say 40,000 rupees. The taxes that I will have to pay is 30%. So I will have to pay 30% of 40,000 as taxes, and that becomes 12,000. So the money remaining with me is 28,000 after giving taxes. Now take the second case. I have taken a loan, and because of that loan, I can earn a further, say, 10,000. So my profits become 50,000. Say the interest that I am paying on that loan is, say, 6,000. So my profits after the interest become 44,000. Again, pay taxes at the rate 30% on it. So that becomes an extra 44,000 into 30%. 13,200. So if you see, by paying tax interest, my amount of taxable income reduces, and therefore my taxes reduce. And because of that, I'm saying it's an advantage. Otherwise, instead of paying 13,200 as tax, I would have had to pay 50,000 into 30%, which is 15,000 of taxes. More of taxes you'll have to pay if there is no interest. Okay. Coming back to what is equity. Equity means the shareholders' equity. That is the amount which belongs to the shareholders. In other words, the owners of a company. So equity is the total capital invested by the owners plus the reserves and surplus. When I say reserves and surplus, the money kept aside by the company out of its profits. And surplus, of course, means profits. Surplus is the synonym of profits. So the total equity is always capital plus reserves and surplus. The second way to calculate equity is the total assets of a company minus the amount of loan that I owe to the outsiders of the business. That is not, if the loan has been taken from the owners of the business, that is not excluded. Anything that I have taken from outside the business, that would be known as outside liabilities. So these are two ways in which we can calculate equity, that is the amount that is due to the owners of the business. So the first ratio which you will have to see when you are investing in a company is the debt equity ratio. What is the debt equity ratio? I have written that on your screen. That is long-term debt divided by equity. Now, you know what is equity, the owner's contribution. You know what is long-term debt. Long-term means non-current debt. Non-current means something that I have taken for more than 12 months. That is your debt equity ratio. The ideal debt equity ratio is 2:1. When I say 2:1, long-term debt can be double that of equity, not more than that. So if the company's debt equity ratio is 2:1 and the company needs immediate money, it cannot go in for loans. Why can it not go in for loans? Because the banks will not want to give them loans because they've already reached double the loan of equity. And the banks will fear their the way they will be able to return the money or not. The bank will also fear whether it will be able to pay the interest or not. So usually the companies, we say the ideal ratio is 2:1, but it is always better if the company keeps it below 2:1, so that anytime the company needs money, it can go to the bank and get money. Uh, Here. So I've given you here, ideal debt equity ratio is 2:1. Higher the debt equity ratio, it indicates that the stock is very risky. Why? Because the company wants a loan. The company will not get a loan because it has already reached that 2:1 ratio. I should not again name the company, but one of the companies which has just not now gone down, its debt equity ratio was very high. I also fail to understand how the banks have given it a loan. It's only because it had that financial backing from the political background, and therefore its debt equity ratio was as high as 10:1, I guess. And that company has recently gone down. Recently means just a 3-4 days back, I can say. That's right. That's right. If you check the ratio, debt equity ratio of this company, Vikasji, it is as high as 10:1. So that means it has taken a lot of loan. And because it has taken a lot of loan, it had to pay a lot of interest. So such companies, although their profits were going very high, they were doing really well, but they are dangerous. So that is why it is important that we understand this fundamental analysis. So please remember that the ideal debt equity ratio is 2:1. So if we have understood the debt equity ratio, then we can start with the other ratios, which is EPS, PE ratio in our tomorrow's session. And I can say very well that if we have understood, it will please me and we can go ahead and understand the other ratios tomorrow. Yes, of course. I can go to slide 4 here. Anjanji, this was slide 4, I think. Anything that you want me to go ahead and explain in slide 4, please let me know. Okay. If we have understood our debt equity ratio, we'll meet tomorrow, same time, that is in the evening at 8. Thank you and good night. Uh, okay, Vanashri ji, next time onwards, I will try and give you a one-liner Hindi also. Ji, bilkul. I will speak in Hindi from tomorrow as well.